All right, this was an insane week that we got to unpack here because we had hot CPI print. We had an insanely hot PPI print. We even saw rate hike odds begin to surge. We saw record household debt get hit. We uncovered that real wages are declining quite significantly. And that's just one story. Now, here's the other story that was playing out simultaneously. The US just cleared Nvidia to sell its most powerful AI chips to China. Trump and Xi agreed that the Strait of Hormuz must stay open. And the Treasury Secretary is calling this inflation transitory and something that we shouldn't be worried about. The market closed at an all-time high of 7,444 in light of all of this normally bad news. And a new Fed chair, Kevin Warsh, just got confirmed by the Senate. We saw really all of these things combined lead to what seems to be a major disconnect between how everyday investors and retail are feeling and what smart money and Wall Street is positioning for. So, what is going on here? Well, most investors are only focusing on the bad news, at least retail is, and we see smart money positioning for something that maybe we don't know about yet. And that's something that we should be paying attention to. So today I'm going to show you kind of how these things connect, at least from my perspective, and what I'm doing about it. And maybe this will help you decide what's really noise and what you should be paying attention to. Because this is a market that just digested the hottest inflation data in 3 years and it barely flinched. The market is telling you something, and your job, our job as an investor, is to listen to these signs. So today I am bringing together everything that landed this week: the macro data, the Beijing summit outcomes, the Nvidia chip clearance, the new Fed chair, and the Treasury Secretary's inflation read. And I'm going to show you why it all points to the same thesis: short-term pain for the long-term gain. So here's how to position for both. Let's dive in. All right, so let's start with what actually happened this week, because there is more news packed into the last 5 days than we have seen, honestly, I don't know, in the last couple months. So Monday and Tuesday, CPI, or monthly CPI print, what kind of inflation are we seeing? It came in at 3.8%. That's a 3-year high. Then the following day, producer price index came in at 6%, blowing way past the estimates by more than a full point. That's a real number that we got to be paying attention to. We also saw that real wages posted their first annual decline since 2023. So we got inflation going up. We have wages and real purchasing power going down. That's a disconnect that is being felt amongst all Americans. Now, household debt hit $18.8 trillion, which is an all-time record. That's up from $4.6 trillion since 2020. Delinquency rates on credit cards and student loans and auto loans are all approaching post-2008 financial crisis levels. And on the face of it, that is a deeply concerning consumer and inflation picture, in my opinion, right? These are things that, if you tease these out for long periods of time, something has to give. And while we all believe that the American consumer is strong, and there's been many data points to show that, I don't know how long this is sustainable. Now, let's go to Wednesday and Thursday. Kevin Warsh was confirmed as the new Federal Reserve chair in a 54-45 Senate vote, which was honestly the most partisan Fed vote in all of the Fed vote history. So he goes and he takes over for Jerome Powell, whose term just ended, and his first meeting is on June 16th. Now, meanwhile, Trump just landed in Beijing with a freaking all-star cast of America's top and most powerful CEOs, including Elon Musk, Tim Cook, Jensen Huang, right? The list goes on and on and on. Larry Fink, right? So who Trump personally called, and he picked all of these individuals up to bring them out to this summit to, what I believe, get some real deals done. This is a guy that is a businessman, right? And he looks at America, our power, the investment opportunities, our economy as a business, and he wants to be the biggest and the baddest and the best. And I love that aspect. And so he's taking our most powerful over to try and get deals done in China. So this summit produced a framework agreement for a constructive, strategic, stable relationship for the ongoing years going forward. Now, both sides agreed, which I thought was positive, on kind of Iran, not being able to have a nuclear weapon, that they agreed that the Strait of Hormuz, of course, right, the critical oil shipping lane, which China gets most of their oil from Iran, right? That it needs to stay open. So, of course, they're going to want to have that conflict wind down. And the US just approved Nvidia's H200 chips for sale to Chinese tech giants, including Alibaba, Tencent, ByteDance, right? Some of their biggest companies. And this morning, we also saw that Treasury Secretary Bessent went on Squawk Box from Beijing, and he said something that I think many people in the market were hoping to hear. Now, whether or not this is true, whether or not it plays out like this, he noted, hey, expect maybe one or two more hot inflation prints, but then expect a substantial disinflation. So basically saying that the inflation that we're seeing, these hot prints, are transitory. They're not sticky. They're going to, flush through the system. A lot of it is being, inflated due to energy and kind of the conflict in Iran, basically signaling that, these things should be winding down, and hopefully these things are going to dissipate over time. So his exact words were, nothing is more transient than a supply shock. And that is what we have seen this full week. So that's a lot to digest. So let me tell you what I think it means. So, I think when we see this, Strait of Hormuz must remain open line, this is the biggest inflation signal of the week. And they are ultimately saying, hey, if we can all keep this open, right, we can all agree to get along here, that ultimately is going to lead to disinflation happening in the coming months. So the man managing the US Treasury sitting in Beijing telling you this inflation is temporary, that's not noise. I think that's something that ultimately we should be paying attention to. And the markets are, at least smart money, are positioning that that actually is going to be the truth, and that we could continue to see more all-time highs hit. Goldman Sachs just updated their S&P 500 target from like 7,500 to 8,000 this year. You've heard Mr. Breedwell on Wealth Building Wednesday and our Money Moves episode say that he thinks there's still more runway. So this is something that is going to be very interesting. Now, the market is voting that that is correct. Corporate earnings grew 12.6% year over year in Q1. Now, the Atlanta Fed is tracking 3.7% GDP growth for Q2. The S&P 500 just had its best month since the COVID snapback of 2020, and companies are hitting profitability at historical highs, even while absorbing this energy cost pressure from the Iran conflict. So the market is not broken, it's forward looking, and it is pricing in a world 12 to 18 months from now where several things have happened. They're believing, from what I'm seeing, where all this money is flowing to, why we continue to go up, right? This AI narrative, this tech narrative, there's so many things that are driving this. And again, Ryan, I think, would be able to speak better specifically to the stock market on this, but they're believing that the Iran war eventually ends or de-escalates here in the very near future. They believe that oil prices are going to come back down, and the futures curve is already pricing exactly that. We've got, I think, the West Texas crude 6 to 9 months out, sitting substantially below today's price. The Strait of Hormuz, just agreed upon by Trump and Xi, that they need to keep it open. This creates the conditions for that move and puts a little bit more pressure on Iran, being that Iran and China are somewhat allies. And the US-China trade framework reduces supply chain friction and input costs across manufacturing, technology, and construction. Now, when you start adding in the tech giants like, Nvidia chip clearance, before export restrictions tightened, Nvidia controlled 95% of China's advanced chip market. China represented 13% of Nvidia's total revenue. So Jensen Huang estimated that China's AI market alone would be worth 50 billion just this year. And that market was largely locked out. Well, guess what? That just got reopened, at least partially. And then you got, right, the Alibabas, the ByteDances, you got all these other big, corporations in China. Now they can buy those chips. Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Imagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple. Focus on first position, asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. So what does that mean for investors? Well, I think it's another sign that AI is here to stay. We're still in the early stages of it, and it's got plenty more runway. I know you got a lot of people like Michael Burry betting the opposite, right? That he's shorting these things. AI infrastructure build out in China is going to accelerate. Nvidia revenue is probably going to continue to climb. So we've got semiconductor supply chains that are, probably going to continue to benefit from things like this. And here's the second order play that nobody's really talking about. A China AI build out requires data centers. Data centers require power, right? They require infrastructure, cooling systems. They require industrial real estate. This is industrial demand, not just domestically in the US, but globally. And this is a meaningful catalyst for this whole sector in space, which many of these US companies who are leaders are going to benefit handsomely from, which our stock market and those investors are going to benefit handsomely from. So this is a bullish indicator, in my opinion, that we've still got room to run here. Now, for real estate investors specifically, if this macro environment resolves the way the market at least is pricing it in right now, if inflation cools, if supply chains stabilize, if trade friction eases, if tariffs kind of drop off, the case for hard assets is only going to get stronger. They're going to benefit. And necessity-based retail holds through the consumer squeeze, at least in the short term. So industrial and logistics demand is going to grow with reshoring and AI infrastructure, and hopefully the 10-year Treasury, which has been the enemy of commercial real estate valuations. It's been going up. I don't like seeing this go up. As an investor who needs to leverage short-term debt, right? We don't like to see this. It's been going in the wrong direction. Well, that gives it plenty of room to fall when energy-driven inflation reverses. That is when the refinance wall cracks open and deal flow is going to resume, that we're going to see some easing on these, financial and economic models that are struggling to make sense right now because of the cost of debt. So this actually could lead to some early signs, if these things all point, where they're pointing and they flush out, that we actually could see the argument for rate cuts at some point in the near future, even though right now all the data is showing that there might be an argument for rate hikes, not even pauses. So it's a lot of stuff going on right now to kind of sort through, right? I mean, the market is already pricing in lower energy. And I think that is really probably the biggest thing that is driving this short-term inflation up, at least for the second half of 2026. So that's something to be paying close attention to. But the Strait of Hormuz getting opened again, which that's a big, kind of linchpin in all of this. This is the pressure release valve on this inflation. And if the Strait reopens, if oil falls, if CPI falls, if rate hike odds fall, right, then everything in investors' portfolios and really all assets are going to benefit from this, and the math is going to change. So here's my honest read on this week, and I want to be just direct, transparent. This is just my personal opinion because I think investors are making a couple mistakes right now. And this is hard when you're betting hard-earned dollars on where things are going to go, right? Mistake one is treating this inflation data like it's 2022. This is a different time. There are different variables in this equation, and it's a different picture with different leadership too. So in 2022, inflation was demand driven. It was broad based. It was embedded in our system based on what happened and what was playing out from COVID and all the money that was printed. The Fed was behind that curve, and it took 500 basis points of rate hikes to break it. This is fundamentally different this time, though. This is an energy shock, geopolitical supply shock driven by the Strait of Hormuz blockade, the, conflict that's going on in Iran. And from what we know, this should be short term, not some long, drawn out forever war. And Scott Bessent said this clearly in his message this morning. Before the Iran war began, core inflation was coming down. It still is much lower than a lot of people think and feel. The oil futures curve is in a backwardation. The market is already pricing in significantly lower costs looking forward. So yes, supply shocks are painful. And the other thing that he noted is they are temporary. And I don't think that's just wishful thinking. I do think that that is what the price of oil 9 months from now is going to, be, and what those futures are telling us. So now mistake number two that I think a lot of people are not paying attention to is assuming that the growth story is guaranteed. Here's where I push back on, the pure optimism. I think there's got to be a healthy level of paranoia in all of this because at the end of the day, anything could happen at any point in time. The market is pricing in a lot of good news. A 22 times forward earnings multiple on the S&P 500 leaves very little margin for error. So this is where I think things are a little bit more fragile and that we have to be cautious, when we're thinking about all this positive stuff playing out perfectly and rate cuts happening and the market continuing to go up. Yes, the Nvidia chip clearance is real, but it's partial. The most advanced chips are still restricted. The Beijing summit, while I think having all of these big names and big companies over there is a great sign for relations and trade and business and all kinds of great stuff happening based on this going forward, because we've never had this kind of summit with China before. I mean, it does show that there's some collaboration and some openness to finding a way forward that we can all win together instead of being enemies. It's not some signed treaty that's guaranteed that we're now going to be best friends and we're all going to play nice together, right? China has a documented history of being, not very transparent, of falsifying data and information, of going back on their commitments. So I think these are things that, we need to be paying attention to and honest with ourselves about. Now, Kevin Warsh is the new Fed chair as of this week, someone who in 2024 was arguing for rate hikes before shifting to cuts once Trump was in office. So, we got to pay attention to what he's going to do, right? This is a regime change. There's a lot of stuff that can go down. His actual policy path is somewhat unknown. So his first meeting is on June 16th. There's still a lot of uncertainty. Markets don't like uncertainty, so we're going to have to pay attention to that. I think there's just, there's signals and there's noise. We got to pay attention to both and find, the truth somewhere in the middle. But what we do know, the signal is the direction of travel. Inflation is supply driven and hopefully should normalize and pull back. I'm hopeful for that. I would like to see that. Growth is genuinely running in the right direction, and the U.S.-China relationship is actually moving in a positive direction, which that's beneficial for the world stage, to be honest. Now, the noise is the daily print that reacts to those signals. And here's where I think this market is telling you that the direction of travel is positive, but there's still a lot of volatility and the bumpy road ahead has not completely smoothed out. Now, the single most important variable in the next 60 days is whether or not this Iran conflict gets resolved. We find some peace deal. The Strait of Hormuz really does de-escalate, and that translates into lower oil prices. So that's what I'm going to be watching like a hawk. It is the master variable for every other data point this year, in my opinion. So we'll have to be paying attention for that. A lot of the other headlines, I think, are just, they're news, they're important, but they are noise. That's the real linchpin in all of this from my personal perspective. So here are the 3 precise moves for this environment. Number 1, own hard assets, right? Don't sit in cash for too long. Every day you sit in cash earning 4% while inflation runs at 3.8, your real return is essentially zero. Hard assets, real estate, right? Being in stocks and equities. Obviously, there's many other ways that you can continue to outperform and hedge against inflation. You're going to get paid either way. So I think this is something very, very important. Now, I also think number 2, watch oil prices as your master variable over the next 60 days, right? The entire inflation thesis, what we're hearing from Scott Bessent, what many other people, believe. And with it, the rate hike thesis, the 10-year Treasury level, these are all really important things. These hinge on whether the Strait of Hormuz de-escalation holds and oil moves lower, and whether this is really transitory or not. Now, number 3 is don't position on announcements, position on delivery, not what they're saying, but what they're doing. So how do these things actually play out? I think these are very, very important things. And our job is just not to react with the crowd, pay attention to the smart money. And it's also just to evaluate whether the delivery and the execution of these things that they're talking about actually play out that way. Discipline over dopamine. The psychology, the more I study this stuff, market makers, the market, the economy, they play off of psychology, and many times it's inverse as to what our human emotions want us to do and what we actually should do. Those are things to be paying attention to. That's where you can get the edge. So the one sentence that captures everything this week gave us the inflation problem and the growth solution simultaneously. And the market is telling you it believes that the solution is bigger than the problems that we might be seeing and feeling in the short term. Maybe it's right, maybe it's early. Either way, the worst thing that you can do is stand on the sidelines waiting for certainty that never comes. One of the best quotes that I love on this, Winston Churchill said, "The pessimist sees difficulty in every opportunity. The optimist sees opportunity in every difficulty." This week handed investors both. And we're going to see who's going to win and play out long term. The one who wins are the ones who see both clearly and they position accordingly. Hope you guys enjoyed this. I'm going to continue to follow, track, break all of this stuff down. You're going to hear more of these kind of macroeconomic breakdowns. The more we can have these tools on our tool belt and this data to kind of help drive the best and clearest decisions around our wealth building decisions, the more we're going to win long term. So if you enjoyed today's show, please do hit that subscribe button. Do share it with somebody that you think could get value from this. If you got comments, thoughts, questions, shoot me a text, 844-447-1555. As always, keep investing in yourself and your wealth on your march to $1 million and beyond. It's my birthday today. I'm 38 years old. I can't believe it. I'm going to go golf with some friends. I'm out. Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at thewiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media, at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself, in your wealth, on your march to $1 million and beyond. Cheers.